Hi, it's Arjun. This week, we will have some fun with a bunch of Bloomberg charts as it relates to the crude oil macro. And we noted in our written post from 2 weeks ago, it's called The Good, the Bad, and the Misunderstood, that crude oil remains a critically important energy source, albeit with some conflicting cross currents at the moment that are both bullish, things like evidence that US shale tier one inventory in particular is maturing, that's a tailwind. But there's also some bearish headwinds, things like China slowing, as well as the near-term oversupply overhang from OPEC plus and others. And whatever one's view of oil, it is still a huge driver of sentiment for the energy sector. And its energy's weighting is going to be driven by some of the largest oil companies out there, ExxonMobil, Chevron, and all the others. And the outlook for oil plays a huge role in that. Let me get into some of the key messages that we want to deliver this week. The first point would simply be that, and we're going to show a bunch of charts, oil is lagging almost all other commodities. I think the second point, I should just mention it, oil is still king when it comes to the energy's weighting in the sector and overall sentiment. It is never about simply waiting for an oil big market. And kind of our final slide that we'll get to towards the end is really how should companies large and small be thinking about this environment. We don't think oil is going away anytime soon. We're not believers in peak demand, as we've noted, but it's also not about just waiting for a super cycle. The next decade, the decade ahead, it's not going to look like last decade or the decade before that or the decade before that. My career started in the 1990s. That was very different than the super cycles of the 2000s, which itself was very different than the 2010s. And this current decade, which is we're in the midst of, is already proving to be yet another new chapter. And for any company out there, whether they're oil leveraged or not, it is about looking forward. How do you lean into it? And what are the actions you're going to take? Today, we will focus, of course, on some of the oilier names and how they might be thinking about things. So I'm going to go through, I think there are 4 charts here, Bloomberg charts of sort of oil versus a bunch of other commodities. And this is oil versus gold. We've highlighted kind of the extreme that we're at right now in terms of gold significantly outperforming oil. The only time it's ever been higher in the last 35 years was at the kind of the depths of COVID when oil obviously briefly went negative. Does this relationship have to normalize? None of them do. These can be and are independent sectors, but just highlighting here, if part of gold's appeal is a hard asset and inflation hedge and so forth, typically there's been a role for oil in that type of environment. And we are noting that gold does look oil, I should say, looks very inexpensive versus gold. Same thing with copper. I think, copper's in red here, oil's in white. And historically, they've moved together. There's been some leads and lags between the two, but they've moved together. I think what's interesting is copper's often very much thought of as a China leveraged commodity. And here you have all these demand concerns. We regularly cite China as a headwind for oil. Yes, there's some EVs and LNG truck ramp ups and that kind of stuff. But I think the biggest question is really GDP outlook in China. They're not poor, but they're no longer rich. A lot of potentially untapped energy potential. You have this divergence between copper and crude. Again, they don't have to go together as markets. They historically have. I think it's worth noting that crude does look very inexpensive here. I think an area that is clearly related is oil versus crack spreads or refining margins. Now, this relationship is more volatile over time. But even here, at a time where we are regularly citing recession and slowing GDP growth and what's the tariff trade war going to be, as concern over demand, the sector that most directly feeds demand, the refining sector, that is you're demanding gasoline, jet fuel, diesel, all the things refiners produce, crack spreads are actually at a near-term higher end of the range versus oil. This is cracks, CRKS, the Gulf Coast 321 crack, divided by WTI. Now, some of this is seasonal. We're entering the seasonally stronger period for refining margins, the summer driving season. Some of this is the very distinct sort of extra supply coming back from OPEC, benefits refiners. And so that's more about, their feedstock going down in price. But this is what's I think becoming evident that the hard data, if you will, has generally been doing better than the soft data. The outlook there is more concern. The hard data generally being stronger economically speaking, we're talking about, I think it's confirmed a little bit by this relationship. Again, it just bears noting that crude oil is what is uniquely weak here. And then just the last area is US natural gas. I think most people are aware of the very sort of positive outlook for natural gas demand. And this is Henry Hub gas prices, which have been very weak structurally over the last, since the shale gas revolution, relative to crude oil. And while there's still, natural gas is still weaker to crude than what we saw pre-shale gas revolution, it is at a relatively stronger point at this exact moment. And I think just a few other things to highlight here. Prior to shale gas, the ratio between oil, WTI, to Henry Hub gas was somewhere in the 8 to 10 to 1 range. Oil prices were 8 to 10 to 1 versus US natural gas. That's this first dotted line from the 1990s to the start of the shale gas revolution. And then as we unlocked all the shale gas, and as we went through a China related and BRICS super cycle on the oil demand side, you saw the ratio blow out in favor of oil, and oil is traded much more richly relative to US natural gas for, again, really now the past 15 years. And with the outlook for natural gas going forward, here in the US from LNG exports and AI demand and all these things, with the outlook for natural gas demand, clearly, don't think there's any debate, clearly better than the outlook for crude oil. Could we go back to that older relationship such that oil isn't actually cheap today? It's simply renormalizing back to maybe not 8 to 1, but something less than what we've seen over the last 15 years. And it bears watching. We've said this in prior videos and written posts that our view is that we are bullish natural gas demand, but we're not necessarily bullish natural gas price. We need enough of the gas price to stimulate more supply and to build infrastructure and so forth, but there is a lot of resource such that we still expect a pretty robust oil to Henry Hub gas price ratio. And we are not expecting, it's not our base case, that we're going to go back to 8 to 1 or 10 to 1 on any sort of sustained basis. But it's a relationship that bears watching, but this is going to be what we're going to call the fourth area, where it looks like crude, at least relative to the trends of the last 15 years, looks more inexpensive versus natural gas at a time, again, of justified optimism towards natural gas demand. We have to keep saying that. Let me shift a little bit to what we're seeing in the equities. And we've shown this chart before. It's the energy stocks in the S&P 500. That's the light blue line. S5ENRS is the Bloomberg ticker for the energy equities in the S&P versus, we're showing this versus the Mag 7. And we have two other indices on here. The Mag 7 are the purple lines. And since the start of 2021, up until Liberation Day, April 2nd of this year, it was to our surprise that energy had drawn, had traded to a draw with the Mag 7. They performed similarly. Clearly, it has felt much more like a Mag 7 market, but that's really been since ChatGPT. So a tale of two periods. Energy outperformed coming out of COVID and into the Russia-Ukraine peak. The ChatGPT going viral started the, quote, AI revolution, the AI trade, and since then it's been all Mag 7. Now, since Liberation Day, after initially trading off together, we're again seeing outperformance of the Mag 7 versus energy. Some of that's all the crude oil weakness that we've previously talked about and we've talked about today. And some of it, again, is just, again, a renewed optimism on some of the IS stuff. But we're not making trading calls here. We would note that we do seem to be at kind of maybe a key resistance level for the Mag 7, so we'll be watching that. We look to be at a key support level for the energy equities. Again, we're not giving trading advice, but we are observing that, again, we seem to be at sort of some key points here, perhaps consistent with some of those commodity charts that we just showed. If you look away from oil and look at other energy areas, they're almost all doing better. The problem is, and we're going to go through natural gas E&Ps, LNG, and the IPPs, is that their weighting in the market is just simply much smaller, such that, again, energy's weighting in the S&P 500, the sentiment towards these sectors is still very crude dominated. But these are the natural gas E&Ps exposed primarily to Henry Hub. They are, again, outperforming decently against, again, the blue line is the S&P, the energy stocks in the S&P 500. The white line is the S&P 500. Nat gas E&Ps outperforming. You see that with the LNG sector. We only had two companies that went back to 2021. We wanted to be consistent with the time periods here, but you got two LNG exporters, U.S. LNG exporters, outperforming energy equities in the S&P 500 and the S&P 500 itself. And then lastly, The sector that's been just a rocket ship are the IPPs. They're the only stocks you can say in the same breath as NVIDIA, a remarkable thing. So we do actually show NVIDIA on this graph. And of course, you've got this trio of IPPs just blowing away energy equities in the S&P 500 and the S&P 500 itself. This is only since 2023. We wanted to get more than just one company on here. But I think people understand this point. But when you look at all these other sectors, clearly investors can gain exposure to them, but the market caps are smaller. They don't drive energy's weighting. At the end of the day, for energy to, again, regain in importance, it's going to be about ultimately the larger companies, as well as companies that can grow into becoming the larger companies of the future. So let me just, a final slide here, talk about how we think about navigating from a strategic standpoint. This could be for corporates, usually what our message is a little more directed to, but also investors, what the strategic alternatives are. So let me start with some of the larger companies. And I think, again, it's kind of a funny thing where some of these larger oil companies, they're the ones going sideways. They're the ones that have kind of flatlined, if you will, as a general comment, since the ChatGPT kind of put the onus back on tech, or put the outperformance back on tech. They are all, in many respects, oil is a huge part of the earnings of these companies, but they're the ones who, in a world, if we start with a world where tier one shale is getting more mature, that tier one means shale oil that works, let's just call it below $70 a barrel, where you have enough inventory then and attractive economics that $70 or below is attractive. That inventory for industry at large is starting to deplete. There are some companies better positioned, but for a lot of industries trying to deplete. So like the interesting thing about some of these larger companies, they're already diversified. They're in the rest of the world. They're in other businesses like LNG and such things. How do they lean into those strengths? Some of them were late to shale. I think they have some good positions now, but they've already been global in orientation. M&A has already been a huge driver. They have the opportunity to continue to consolidate companies that don't think they can go it alone anymore. They have the balance sheet strength. And what are the new areas that make sense? They've got massive balance sheets. Our view towards natural gas, including LNG, is that you don't want to just be making a price bet, but that there is significant growth. So what are going to be the low-cost opportunities around the world? How do you play into volatility using your balance sheet strength, using the ability to trade natural gas or LNG into different locations? You see the Trafigurs, Glencores, Vitals of the world, the kind of the pure merchant traders increasingly wanting to own physical assets. For some of these larger players with large physical assets, going in the other direction, going towards trading, they've all been doing it to varying degrees. There's an opportunity to lean into that. And our point in all this is there's a lot for these companies to do. So let's take advantage of what is currently a lackluster and inexpensive and uncertain outlook for oil. Do you want to do M&A? What are the areas you want to lean into on a diversified basis? What are the new businesses in those currently more exciting areas? We do think structurally the power value chain is going to do better than the crude oil value chain over the next 5 years. That includes the natural gas value chain. What are the opportunities for these bigger? It is an exciting time for big oil, even as those stocks are going sideways and driving a lackluster S&P weighting. I think for this mid caps, or I probably should say the non-large caps. I think that's what I wrote here, the non-large caps. What do you want to do? And so a number of them have been choosing to sell to a larger company. That's not going to be there for everybody forever, but obviously an option. You've not really seen anyone take the yield vehicle route where you kind of try to draw out remaining inventory. You're trying to distribute all your excess cash back to investors. It's not obvious that a pure play shale E&P can totally do that, but I think it's worth examining. And then, are there combinations that can make for a better company? There may be a select number of companies. I'm going to call the ones that, sorry for the phrasing, the better managed companies that might be able to think about selective diversification. There's some examples of that. We're going to refrain from mentioning individual names here on Super Spiked in a public setting. I think there are some companies that are going to be looking at diversification opportunities where it will work out for shareholders. But there's going to be a whole larger subset of companies where investors are going to be like, wait a minute, you shale pure play are going to go into some random international country. We've seen that movie before, and it's been challenging for a whole bunch of people. So then the question is, if you are a shale pure play, what are there strategic combinations that would make sense? A lot of the non-shale guys are generally less expensively valued than has been shale or have underperformed shale over the last 10 years. Is there an opportunity for those to come back? I think there's a very different set of things to think about for the non-large cap companies relative to the large cap, and it is a more uncertain environment. I'm going to mention it at the end, and it deserves its own video. But I loved Tim Hodgson's speech, the new Minister of Energy in Canada, to the Calgary Chamber of Commerce. You can find it on YouTube. I think the key messages Minister Hodgson, I think would be the correct phrasing, delivers is absolutely outstanding. He talks about energy being Canada's superpower and Canada becoming an energy superpower. Love that message. That Canada's going to be focused on delivery going forward and not delay. That is a huge change from years past. Love that messaging. Tim Hodgson is a former Goldman colleague. I personally don't have recollections of working with him. He was on the banking side. I was a research guy, but a number of my colleagues are former Goldman colleagues that say, remember working with him, and comes highly recommended as a very sensible, pragmatic person. We are pretty excited about the outlook for Canada. I think longtime Super Spike subscribers know that we have had a very favorable view of the Canadian oil and gas industry in terms of its resource potential and the ability to generate returns. And I think in an environment where the political backdrop is improving, again, it's a topic worth coming back to in its own right. What is the role for either large or smaller companies to play into Canada? I think these are all topics we're going to spend a lot more time on, but whether it's Tim Hodgson, whether it's the seemingly improving political landscape in Canada, whether it is what has always been an attractive long-term resource that can generate very competitive returns on capital, I think Canada is going to be a really important country to focus on going forward. And the last area is global shale. It's something that we've been somewhat dismissive of. I think there's some really unique reasons for why U.S. and to a lesser degree Canadian shale have succeeded in a way that you've not seen in the rest of the world. But under the new leader, Milei, Argentina's Vaca Muertes had a pretty good comeback. There's some leading companies in that play. There are some opportunities in the Middle East elsewhere. I think there's still a lot of questions to be answered, but maybe some of those same companies we were talking about before, who have some of those really special management teams that could think about what would make sense on the international shale front. So I'll end this video on a personal note, and I do want to take this opportunity to recognize that even in Canada, we're now seeing business leaders, again, as like my former Goldman colleague, Tim Hodgson, go into government. And I think it's interesting and noteworthy at a time where people are very down on political parties, especially here in the US, whoever you voted for, whoever you don't like, there's been this notion of there's extremism and too much ideology and all this stuff that have crept into both of our US political parties. It is great to see. I've mentioned, of course, my friend Chris Wright, who's now our energy secretary. I love the fact that former Governor Burgum, now Secretary Burgum, I should say, is also a business person. A lot of folks that are going into both the energy department and the interior department are people I know, all of whom come from the business world. You still need people who understand government, who understand all the rules and regulations and how to write laws and pass bills and all this stuff. But to have this influx of business people into our government, and now we're seeing it in Canada as well. I'm not a Canadian political expert. I am excited for Tim Hodgson to be the energy minister of Canada. It is, I will say it's an encouraging sign. And I think we could use more of it. And I'm going to end this on an optimistic note that this public service by business people, I want to applaud them. It hasn't been something that has been right for me up to this moment in time. But I do hope that however we can be supportive, however I can be supportive of these folks, I view it as a very good thing that we are seeing business people attracted to serving their respective countries, at least and especially in the energy and in the US in the interior departments. Thank you.